Are you a landlord looking to maximize your profit? Nobody invests in real estate to lose money, regardless of their end goal. I'm Josh with Sissel Management Company, and making financial fumbles is mistake number 4 in our series of 5 mistakes that cost rental property owners money. As a real estate investor, are you looking for cash flow, appreciation, and financial freedom? Or did you buy a property hoping to hold it until retirement? Or are you a parent who bought the property hoping that this will be the thing that funds your child's college fund? There are tons of different reasons why people own rental property, but no matter the reason, everyone wants to make a return on their money. Some people want huge returns, they're really about that percentage, and others have different goals and different agendas, so the return doesn't matter as much. But no one wants to look back after 15 years and wonder why they just didn't make any money, while they went through all that hard work for nothing. But I thought making money in real estate was a shoo-in. Here are financial fumbles that I see happen again and again. As I'm looking through ads online, I see owners who set their rent far too high and way too low. If you set your rent too high, you may get prospects. There may be people that come out, and there may be someone you rent it to. But the problem is you're probably going to rent it to someone who is not financially responsible. If they're willing to pay too much for a property, they don't make good financial decisions. Too low, and you aren't covering your costs each month. A lot of property owners look at their mortgage and think if that's covered, then they're good. But there are a lot more expenses to go along with a rental property than just your mortgage. Another financial fumble we see is leasing to poorly qualified residents. This goes back to mistake number 1 of not having objective rental criteria. Not only do you have trouble with getting payments on time, but an irresponsible tenant likely won't care for the home, so you have a mess to clean up after they move out. Don't forget to figure in the cost of the added stress and the time spent with an irresponsible tenant. Time is your most valuable asset, and you can't get it back. The next financial fumble that I see property owners make is to not make improvements to their home. Why does the IRS allow you to depreciate your home out over 27 and a half years? They just want to give you free money? No, it's because your home is aging and the property, not the land, but the home itself does depreciate. It wears out. Things have to be replaced. Am I saying you need to remodel your home every time a new fad comes along? No. I see properties that have never been remodeled, they've never been updated at all. The owners have done as few repairs as possible. They just do what they have to do, and then they wonder why they're getting $500 to $600 less a month in rent, or they're getting bad residents that tear up the property. If you want good residents to care for the home, you have to care for the home. Think about this. If you spend $10,000 to update your property with some new floors and new paint, because of this, you're able to bring in $150 more a month in rent. That's $1,800 on the year. $1,800 divided by $10,000 is 18% return on your money. Not only have you made more money, but you've put yourself in a position to get better quality residents, because good residents want to live in a home that's cared for. The next financial fumble we see is poor financial planning, not planning for repairs and capital expenses. As I mentioned earlier, your mortgage is not the only expense you have to cover. Standard practice is to hold back in reserves 10% for maintenance and 10% for capital expenses. If it's a relatively new property, you may get away with spending only 5% your first 10 years on maintenance. And then you may average 15% a year for the next 10 years. One more expense that self-managers almost never consider is management cost. They feel that they don't have a cost since they're doing it themselves, but that's not the case. Their time is worth something, and if they're not figuring that in when calculating their rental rates, they're losing money. The final financial fumble I want to talk about is lax accounting practices. How many of you have a drawer full of receipts and dread tax time? Or maybe you had big plans to keep up with everything in rental software so you could pull these quick and easy reports and know exactly where you are, but life got in the way. Now, the only expense that you can quickly pull up is your mortgage payment. Keeping track of expenses is such a simple thing to do. Why is it so difficult? You're busy and you don't take the few minutes you should each week to organize your receipts and your expenses. And because of this, you could be missing tax deductions and making blind financial decisions. So let me give you an example. About 2 years ago, I had a client reach out about a property they saw online. I called the listing agent to get the details and the numbers on the previous rental history. The agent let me know that her client told her he was making about $300 more a month by renting it as a weekend rental rather than a long-term rental. I asked for the owner's records, and he was making $300 more a month, except he wasn't keeping track of utilities, the internet, the tourism tax, and the management cost, which is extremely high considering it was a short-term rental. After calculating all of that, he was actually making $100 less a month than he would have if he would just had a long-term renter in the property. This investor was making blind decisions because he didn't have good financial records. So that's a wrap for this week's video. Don't forget to like, subscribe, all that cheesy stuff they tell you to do at the end of every YouTube video. If you have any questions, please let me know. Until next time,